and then we will get started. All right. Now to introduce our speaker and moderator of the investing discussion group, Kristen Jacks. Kristen Jacks is a financial educator, author, and the founder of Money in Your Twenties. Kristen worked for Kiplinger's Personal Finance magazine and Mutual Funds magazine before becoming a writer and speaker. Her most recent book on investing is a lively and jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Thank you, Kristen.
Oh, thank you so much. And thank you to Greenwich Library. You guys do wonderful programs. It's just so great, everything that you offer, all of Greenwich and beyond. So welcome everybody. This is the investing discussion group. Believe it or not, this is our fourth season. We meet once a month online and we tackle topics that you guys really like for us to cover, whether it's like the macro environment or alternative investing. Bonds is always a very popular topic. Tax, saving on taxes. We did that last time. That was very popular. We're even going to do crypto in 2026. So we're going to cover a lot of territory. So welcome. And these sessions, as Siobhan said, are taped and they live on the library's YouTube channel. And if you don't know how to find that, you just go to YouTube and then in the search bar, you enter Greenwich Library. And of the things that pop up, one thing you'll see is the Greenwich logo, which is this green and white logo. It looks like an open book with a tree in it. And if you click on that, it takes you to all the videos that the library does. And the ones on the investing discussion group are very clearly marked and very easy to find. So the ones that we've done in the past on asset allocation, paying zero taxes in retirement, that was a very popular one. So you can find all of those on the library's YouTube channel. So today we're doing how psychology impacts your investing decisions. And then planning ahead in December, we're going to do alternative investments. And so what do we mean by that? Well, when you think of investing, most people think stocks and bonds. And that was definitely the way things had been for years. And then David Swensen of the Yale Endowment really rocked the investing world when he shared his investing philosophy that was so rooted in these private investments. Also, real estate, he was a big believer in real estate holdings. So that was a departure from stocks and bonds, but also private equity. It's like I remember, 30 years ago, you like never heard about private equity. Like that was not a thing, and now it's everywhere. And then private credit. So like you're actually like you're bypassing all the public markets. So instead of bonds, there's private credit. Instead of stocks, there's private equity. So that's what we're going to cover in December. Thank you, David Swensen of Yale, for giving us this new horizon. And I think that's going to be really, really interesting. Okay. But tonight we're doing how psychology impacts investing. And it's a huge topic, obviously. So we've got to really drill down like what's the best use of our 55 minutes. And I think we're going to start with the grand theories first, with the big guys. So this is, these are not like pop psychology things. These are not like articles that you read in like some women's magazine. Like we have Nobel Prize winners that have taken this idea of like, economics and decision making is not logical, it is not sober, it is not mathematical, it is not all these things that economists, previously had sort of hoped to say about their field, that there's really like a lot of emotion and a lot of illogic and psychology behind the decisions that we're making that are financial. And so we actually have like a bunch of Nobel Prize winners who, I mean, they won the Nobel Prize kind of like for being contrarian and really showing that there's this whole other side to economics and psychology and decision making, other than this sort of sober reality that maybe the University of Chicago professors would like you to think otherwise. So we'll start with the big guys. And then knowing that it was kind of like their work that launched all of this, we'll drill down to things that are just much more digestible. So we'll start with like the grand theory, but then we'll drill down to things that are more digestible. So the notable biases, and by notable I mean relevant to you, that science has shown, research has shown that these exist and that they're going to impact you. And then I wanted to cover navigating joint decision making because, very often if you are investing, it might not be just for you, or you might have a spouse that you have to navigate this with, or maybe you're helping your parents and you're trying to convince them of something, or maybe you're a parent and you're trying to convince your adult child to start thinking about their future more financially. So joint decision making is very, very interesting, and it departs from solo decision making. And then we'll also talk on like what the studies show about motivation and what the experts say about motivation, because that's going to be a big factor in whether or not you can start a plan, stick to a plan. I mean, we're just all trying to like save and make good decisions and not panic when things go wrong. So we'll cover that. And then we'll have questions, always at the end, but also throughout. Please feel free to participate. This is supposed to be a discussion group. It's the investing discussion group. Some people are a little shy about participating. So if you don't want to unmute, you're always welcome to unmute and ask a question, but you could also put a question in the chat. So that can happen anytime, but then we do take a part at the end. So, if you didn't get a chance to ask a question, we can take time at the end. Okay, but a quick disclaimer, this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investing strategies mentioned in this discussion group are specifically recommended or discouraged. Before making financial decisions, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, it should be simple, right? Like it's simple. You save money and then you buy low and sell high, right? That shouldn't be so hard. Why are we even here tonight? It's simple. Save money, then buy low, sell high. Well, we're here because that's not what happens in reality. So Morgan Housel wrote it's got to be now the best-selling, the highest selling book in personal finance in history. So when I bought my copy, the book cover said 2 million copies sold. I recently heard on a podcast, because now Morgan Housel's on his third book, that he's now sold 10 million copies of The Psychology of Money. So that is like far and away the best-selling book in personal finance ever. And I think it was so appealing because when he got into this psychology of money, he's like, look, you know, we all understand we're supposed to be saving, we're supposed to be making good decisions, we're supposed to be, putting money away for retirement. We're not supposed to be following trends. We're not supposed to be panicking when things go wrong. But, you're not a robot. I'm not a robot. You're not a spreadsheet. You're a person, a screwed up emotional person. I'm a screwed up emotional person. And he really struck a chord with this book of like, this is why it's hard. And this is how you could make it easier for yourself. And these are the pitfalls and these are the things to look for. But interestingly enough, like he was, Morgan Housel's background, he didn't even, I don't think even has a psych degree. He was a journalist, briefly for the Wall Street Journal, then for this kind of well-known website in the investing world called The Motley Fool. And he's just a really smart, observant guy and a student of history. And I would have to guess he was a history major in college. And he just really like to keep track of how people made decisions and what history had to show about how people made decisions. And his book, which actually you could read, like each chapter is almost like its own little mini essay. So you don't even have to go in any particular order, but it's really like his observations on behavior. And then he had these observations and then he actually backed it up by getting the research. But we're here tonight because it's saving money and investing it wisely and not panicking and all those things that it's not easy to do. But can be helpful to kind of have a heads up on like, where are you going to get derailed? What should you be looking for? What are the biases that kind of, that science is now showing, research is not now showing impact us? Okay, so, and why do I say science, right? Like that sounds kind of weird, like with the emotions, how are emotions science? So what I mean is when you have predictable patterns of people being irrational or predictable patterns of people being illogical, that's science, right? So that's what these Nobel Prize winners, had discovered. It's like we're not just logical, cold, maximizing in our decision making. Okay, so who are these Nobel Prize winners? And I said I would start with the grand theories and the big guns, and you definitely like the if you want to study this independently, these are the unfortunately for now, these are the guys, right? There are like no women, notable women right now in this field, which is kind of sad. Although I might take that back. There is a woman who runs a podcast called Choiceology, and I guess you could argue that she's kind of up there. But for now, the big guns are Robert Schiller at Yale, Danny Kahneman, and Amos Tversky. They started in the 70s. I mean, they're really like the founding fathers of this whole like psychology and decision making universe. And Richard Thaler at the University of Chicago. It's kind of funny that he's at the University of Chicago because that was like the bastion of rationality. And that's where like the efficient market hypothesis comes from. And that's where you think you just have like the mathematical, sober economists, right? And I think they threw Richard Thaler in there you know, just to be challenging and just to make everything more interesting. So these are the Nobel Prize winners that are saying that there is something called behavioral economics, not just straight hard science economics, supply and demand and utility and all those things. They're saying, no, man is not rational, and therefore you have to have a science around how the decision making is irrational. And that's what the behavioral economists are doing. And these guys in the middle, Danny Kahneman and Amos Tversky, they started all of this. They were Israeli psychologists in the 70s who started noticing all of these sort of predictable, illogical, sort of the predictable, irrational behavior of people, and they could replicate it scientifically. So they were the kind of the founding fathers. All right. Just some people like the history and kind of a timeline, so I tried to make this a little bit fun. But if you start with like probably one of the most famous economists ever in history, so you have John Maynard Keynes, and I recently learned on a podcast that I had been pronouncing his name wrong. So when you think of John Maynard Keynes, think Candy Canes, right? So it's not Keynes. I always thought it was Keynes. So apparently it's John Maynard Keynes, and he was, arguably the most famous economist of, this era. And he came up with a lot of incredible theories, but like he alluded to something called animal spirits. And that was sort of talking about how, people's emotions and biases and their optimism or their pessimism, these things that weren't like purely logical or mathematical, were really driving factors in the economy. And when he said that, like people were like okay with it. This was in the 1930s. I think this was 1936, actually, his general theory of employment and money and blah, blah, blah. And then also Benjamin Graham, who's famous for writing The Intelligent Investor, he said in his book that markets in general are kind of like, the behavior of the market is almost like the behavior of someone who has bipolar disorder. I mean, I think back then he called it manic depressive. And he wasn't joking. Like he was like, markets are too high when they're high, they're too low when they're low. It's kind of unpredictable to figure out these swings. And so that kind of language in the 30s and 40s was very normal. And then everything changed. And there nobody is quite sure why. It's almost like the economists wanted to be taken more seriously and they wanted things to be more mathematical and they wanted just economics to be more like physics rather than some soft science like, being a sociologist. And so there was this real push to talk about economics and decision making as very hyper rational and hyper mathematical. And so that's what you had with like Paul Samuelson and Eugene Fama. Eugene Fama, especially at the University of Chicago, he's famous for the efficient market hypothesis. And so he was really, you know, pressing the rationality part of all the decision making and that markets are perfectly efficient. You're not seeing this mania. There's no such thing as bipolar in the market. Um, the, 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 the price is always right, basically, because it just reflects all of the current information and all the best thinking around the current information. So this was a real departure. So forget Keynes, forget animal spirits, forget the intelligent investor and the bipolar behavior. Now, in the 70s and 80s, what was ushered in was this like hyper rationality. And then you have our guys come in, the guys that we're featuring tonight, and they're the ones kind of saying, no, 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 slow down. Like the people are not rational in their decisions. They are not calm. And we're going to show you, but since there's such a basis in science that you have to have research and it has to be something that you can replicate. And that's how it becomes the irrationality has some kind of logical pattern to it. And that's what people need to understand about their decision making. So that's what we're going to cover. Okay. And I just love this because I love Peter Lynch and he used to run the Magellan Fund. And, so he's like in the trenches running this massive fund, looking at the markets every day. And he's saying the academics taught me that the things I saw happening at Fidelity couldn't be happening. So, he's in there going, this hyper rationality is definitely not the case. So let's drill down to what it really is. Okay. So those are the theories at the highest level. I'm not going to describe them here because the language is so non-intuitive and it's just yucky. It's like the academic part is so yucky. It kind of reminded me of this book, How to Speak Money, where John Lanchester talks about how, at some level, like money, it become like it's almost like the people who run funds want to be confusing and they want to use language that you can't decode so that maybe you feel like you need to have a fund manager or something like that. So, coupon on a bond. If someone didn't teach it to you, you wouldn't know what it is. Premium on insurance, like the language is not intuitive. So it's the same thing with these academics. So what they actually call their theories, like the prospect theory and the endowment effect, you'd never guess what they really are. So I'm going to actually drill it down to the different biases that have been identified in language that you can understand. But just so you know, like if you ever study this on your own, you're going to, oh, Daniel Kahneman is famous for prospect theory, and that's not going to make any sense to you. So we'll just drill down to like, well, what did that mean? Which part actually applies to you? And that's loss aversion. So we'll get to that. Okay. Oh, okay, yeah. So here are in plain language. Now we're going to talk about the notable biases. So this is what is exactly relevant to you. Okay. Here we go. So of this, the prospect theory endowment effect, I'm not going to talk about prospect theory in whole because it's all broken out in the cognitive biases that I'm going to show you. But the endowment effect, which you would never guess what this means, it is pretty straightforward. It's just that what it's called doesn't really make any sense. So if you own something, it has more value to you than is sort of rational or anything that the market, in a market of bidders, that anyone would actually pay. So this was something that Richard Thaler became famous for, showing that it was sort of this, this idea that people are rational and that they understand the value of things, that completely falls apart when it's something that they personally own. And this is very telling, certainly with the investments that you own, but almost anybody who owns a home and has lived there for a while and then goes to sell it, usually it's very, very hard to get that person to be rational about the true value of the home. And then one of the worst things you can do when you go to sell your home is come out with a price too high, right? Because you've turned off people. They're not going to even come look at it. They don't want the price of your home to be anchored to something that's too high, right? Because that's just an uphill battle trying to get the price down. So in the endowment effect was one of the first theories that really the science and the research showed that when people own something, they don't know how to value it correctly. They overprice it. So that's, definitely worthwhile. Like if you have stocks or you have any kind of asset, are you being realistic about what it's worth? Are you being realistic about maybe, you need to go sell it and maybe it's not performing as well as it used to, and you can't accept that, right? Like you should sell it, it's run its course, it's no longer a good investment, but because you've owned it for a while, maybe it's Disney stock. Maybe it's something that even has like some kind of personal appeal. You're not going to be rational about its value. And this is something that science, it's been replicated several times, this endowment effect. So whenever you've held on to something for a while, you need to try to be more realistic about what it's really worth. Okay, and then the Dunning-Kruger effect is really fascinating, and it's always misexplained, or it's only, to be honest, half explained. So the Dunning-Kruger effect is usually referred to as people are overconfident, right? They think they know more than they do. They think they have more skill than they actually have. So if you're going to navigate choosing investments, obviously that would be a handicap, to say the least. If you don't know that you're being overconfident, you don't know that you're not as skilled as you should be. So that's the way the Dunning-Kruger effect is always explained, that this is a phenomenon that exists and has been replicated. But that's only half the story. And it kind of bugs me when only half of it is explained. So, what it really shows is people that don't have a tremendous amount of knowledge are usually overconfident about their abilities. But people who do have a lot of knowledge usually underestimate their ability. So, I mean, depending on who's listening right now, maybe you have been studying, maybe you read the Wall Street Journal every day. Maybe you took finance courses in college. Maybe you've read a bunch of personal finance books. Maybe you actually know how to evaluate a stock based on the fundamentals, but also the macroeconomic environment. I mean, the Dunning-Kruger effect doesn't mean universally that everyone's just being overconfident, and that's, obviously a hazard. But if you, and this, since I have in the past interacted with a lot of young people, my first book was Money in Your Twenties. And when you get young people talking about investing, it's a little bit scary. So even these guys who came to paint my porch one summer, they were all students at University of Connecticut, and they were all doing options trading on Robinhood. It was frightening. I mean, talk about like overconfidence when you don't have enough skill. So that's definitely like the bad part of the Dunning-Kruger effect, where, all these young men are sort of like getting Robinhood accounts and trading options, and they're just getting destroyed, right? I mean, this is why day traders exist, because they can just steal money from these newbies that don't know what they're doing. Um, but meanwhile, on the other side, I mean, I don't know you personally, and maybe you really know your stuff. So don't think that overconfidence is the overall message, because you might actually have the problem of being underconfident. You might actually be very capable of making decisions, but maybe you delegate too much, right? Or maybe you are frozen and you're not making decisions at all because you don't have any confidence that you could make good ones. But actually, not only are you intelligent, but you have studied the markets. You've learned, how stocks are priced and why their prices fluctuate. So when it comes to this Dunning-Kruger effect, don't just land in the overconfidence camp. It could very well be based on who you are that you're not confident enough, right? And so you should get out there and test some of your decisions and push yourself and don't be paralyzed, and and have some fun. Okay. So this loss aversion is probably the most important part of the grand theory, prospect theory. So I wasn't going to get into like the grand theory, but what it really drills down to is that we feel losses. They have kind of twice the weight as gains. They have the energy or the impact, the psychological impact. They are twice as powerful as a gain. So for example, if you're going to make $1,000 on an investment, hey, great, feels great. But if you made an investment carefully and then over time you realize you lost $1,000, it hurts. And it hurts. The science actually shows this. It's really interesting that it hurts twice as much. The impact is twice as powerful. So, because of loss aversion and because of this phenomenon, where, depending on your financial situation, $1,000 gain, $1,000 loss, neither one should really have that much impact. But the fact that universally losses have much more weight than gains, that's something that you should know. And then the theory is that if that's true, then you're probably more risk averse than you realize, right? So when you think, when people are asked by financial planners, like, well, what's your risk profile? How comfortable are you with risk? And you think, oh, I'm fine. I'm good. I can do a normal amount of risk. And then you've never really sat through, a market going down for like a month. Well, you might feel a lot more upset than you expected when you have like a basket of stocks, say, that were well selected and you like these stocks. It's like Disney and General Motors and Amazon and all these things. And you feel very confident about the companies that you're investing in. But just overall, the market is down and it's down significantly. You are a candidate for panic selling. And you might not be able to foresee that, right? Because you haven't been in that situation. But just knowing in advance that losses are twice as painful as gains is helpful. And then also maybe having some kind of doing a few things in advance, right? So if you're going to have investments and markets go up, markets go down, they are so volatile, they usually recover, but maybe not in a time frame that's acceptable to you. So knowing that loss aversion is a phenomenon and knowing the pain, it's a really good idea to only invest money that you do not need for the next 3 to 5 years under any circumstance, right? If you're going to get into it's stocks, right? Because stocks fluctuate. You, it's going to be painful enough to watch the stocks get pummeled, but if you actually need that money and now your misery is going to be too much, and then you panic sell, and then that's like the worst thing you can do because now you've locked in this loss. So it's just important to know that you might have those feelings, or like the research shows that you're going to have those feelings. So maybe one way is to make sure you're only using money that you don't even have to look, better if you don't look while the market's down. Yeah, that's just something, the science says this happens and you should know about it. Okay, confirmation bias. A lot of people are familiar with this just in and outside of investing. It's like whatever you already believe about any particular topic, right? That we just are prone to go out in the world and like almost like our brains seek the information or notice the information that confirms our opinion or confirms what we already believe. And this is a problem on a lot of levels, right? So, because you're maybe not that open to correction or to learning or whatever. But with an investment, if you are like absolutely sure that you know what you're doing and you think Nvidia, even though it's been down the last couple of days, it's going to come roaring back, you're going to go out and see only the things, the articles that confirm the belief that you already have, right? So knowing this, it's just a really good idea to just always be open to the contrary, opinion. Or maybe ask somebody, it's like play devil's advocate for me. Like, what am I not seeing? What am I getting wrong here? Why would this possibly be a bad idea? So confirmation bias is, very well known, absolutely exists. And so it's a good idea that you just you're guarding against that. Okay, anchoring bias is really interesting. I think, and it gets a little bit also similar to recency bias, but like you can get anchored in something. For example, an example that's always given is like if, say, you're shopping for a car and a salesman takes you over to like first to the really, really expensive cars. And so maybe you're seeing cars that are like have a sticker price of $70,000. Well, then when you see a car that was much more in line with your budget, like say it was like $50,000, you're like, Oh, that seems like pretty reasonably priced because you've been anchored to some higher price. And of course, none of that makes any sense because you have no idea if a particular car is a good value. All that's happened is that a much higher price you've been anchored to a much higher price, and that's what is making you feel like something is at a discount or something is a good value. And salespeople do this all the time, right? So that they'll show you the really expensive house before they show you the houses that are in your price range. So it's a really good idea if you're trying to pick investments that you really just don't pay any attention to maybe the current prices and don't get anchored to anything. And you really maybe look at prices from like 3 or 4 years ago, or try to figure out, certainly if it's a stock, like what's its price to earnings ratio? Like how do figure out what you think something is worth? What is its value? And don't let
What
yourself
about
get anchored to something that's really like a bad anchor. So the anchoring bias has definitely been, shown, proven, whatever. It's definitely a gimmick that salespeople use. But when you're trying to evaluate investments, whether you want to buy a stock or a piece of real estate or anything, make sure you're not getting anchored to high prices, and you're sort of bypassing just the normal work you need to do to figure out what you think the value is. And I always think this is sort of similar to recency bias, but I think it is because recently, in our recent memory, so many assets have been so expensive, whether it's real estate or gold or stocks. I mean, everything is like, it's like the everything bubble. So if you're looking at things that are recent, you might think that, a certain tech stock, at $600 a share, well, oh, that seems reasonable. I mean, the prices are so out of whack that you're really getting angry. You're very much in danger with the recency bias and the anchoring bias of overpaying for assets at this point. So you really want to just slow down and not buy into that, or maybe go back and look at prices when we had a terrible year in 2022. And if there's any particular stock that you like, you can very easily on Yahoo Finance or anything, you click on the 5-year price, the price over the last 5 years, and you'll see it's like it was half, or a third of what it is today. So, if you're going to anchor yourself, anchor to value, anchor to the discount, not to the incredible like excess that we have right now. Okay, and then action bias is really, really important because as a species, we are just, in especially in times of trouble, we are prone to action. We think action is better than inaction, right? So the problem is when markets start having trouble, once you're in, if you made your decisions and you're in, and then you start to notice trouble, usually the best thing to do is to do nothing, right? I think it was John Bogle who started Vanguard who joked that so instead of like, don't just stand there, do something, it's like, don't just do something, stand there, right? Like, this is what investors really need to do in times of trouble, as long as they've really put a lot of thought into their investments, right? So it's like panic selling is always the bad idea. So just know that you will want to do something and that is a bias. And very often in investing, doing nothing is a much, much better course. Okay, and then this last one I just threw in, just to remind everybody, if you look, not in recent memory because the U.S. stock market has been so strong, but back in 2021, 2020, it's a big, big world out there. And there have actually been years where the performance of the U.S. stock market, the U.S. stock market hasn't even been one of the top five markets, right? I mean, in 2017, you had Austria, Hong Kong, Singapore, Denmark, the Netherlands. Like, they had the hottest stock markets. The US wasn't even in the picture, right? So there is something called home country bias, right? And there's just a bias toward things that are more familiar. I mean, this is why people get in trouble owning too much of like their company stock and not being diversified enough. So another bias you're going to have is like sort of a bias toward the familiar. In investing, they call it also home country bias if you're just piling in only with US companies, US stocks, things like that. But it's, it's just, it's a good reminder. Like, it doesn't hurt to have an international fund. Getting back to David Swenson at Yale, who we're profiling, next in our next session in December. I mean, when he was talking about like, I mean, he just changed people's investing philosophy entirely. And he was talking about private equity and real estate and things like that, but he was also talking about international stocks, right? So even when he was talking about stocks and bonds, he's like, get your mind out of just, US only, like look elsewhere. So I always like to show this slide just to give people a sense of like, sometimes it's like the stock market in Canada is doing better than the US. And sometimes it's like the stock market in Norway. I mean, I personally, I'm not sure that would have a lot of application to me, but I could see like getting into the Japanese stock market or getting into sort of an Asia fund or, something like that. Like just get your mind out of the United States. You have we mostly all of us probably have this home country bias. And okay, so I've told you about all these biases, but like, what does it really mean? Where do we really see it shake out? And Dalbar has been doing research forever about how even if, the market, let's say, like you say, the S&P 500 represents the market, even if the market goes up a certain amount, the typical investor misses out on the full gain because of the, if you aggregate all these biases, it turns into like bad behavior, right? Maybe someone's like chasing returns and buying things just because they're hot. Maybe someone's panic selling just because the market has like a hiccup of volatility. I mean, it's amazing to think it was within this year, right? So in 2025, in April, the market was horrible. I mean, if you look at any chart of what April looked like compared to start at, the beginning of the year, then to April, then to now, it's like this huge dip. And if you were looking at your portfolio then or looking at different stocks that you own, I mean, you might have really panicked, right? It's hard to watch. So investors, I mean, the research shows that investors do not benefit when the market is up. They don't capture all those gains because all of these biases kind of hit us and then we make poor decisions. So this particular Dalber study, I mean, it's just kind of typical of like they do it every year, and this is just what ends up happening. You're going to make 16% instead of the market. The market returned 25%, but you only make 16%. That's a huge swing. So that's why knowing about these biases could really help you to avoid what has become like pretty typical sort of investor error. In fact, there's even I think I have the book cover somewhere on one of my slides, but there's a famous investing book called, oh no, what's it called? Winning the Loser's Game. And the guy who wrote it likens like your job to like in a tennis match where so much of tennis is unforced errors, right? So it's not like playing the game brilliantly. It's avoiding these unforced errors. And so that's really like these biases are like the unforced errors. And so just avoiding them will help you like winning the loser's game. Okay. Now I just threw this in there because we've been talking so much about like behavior and bias and emotion and bipolar markets and manic markets and animal spirits and things like that. I don't want to give you the impression that this is the only thing that's happening in the market. So, in my book on investing, in chapter 3, I actually asked the question like, why did that stock price move? And then I walk through, it's either going to be in isolation or in combination, something's going on with the fundamentals. Maybe the CFO just resigned, right? Maybe earnings weren't that good. So that's the stuff that's really core to the company, to the publicly traded company, to the stock. Maybe it's the macro environment, right? So that's where, when you have tariffs, right? Like that's macro. That's like, the company didn't do anything. It's just sitting there. But politicians have decided that we're going to have tariffs when we didn't have tariffs before. We're going to have much higher tariffs when we had lower tariffs before. So that's macro. What we've been talking about tonight is all the behavioral finance, right? But this is just only one part of the picture. Then there are technicals of people that's very controversial. People don't necessarily believe in it, but I'm just putting it in there that just to mention it. And then there are other things, right? Sometimes a stock can have an amazing run up because of short covering, right? So if you don't know what that is, when investors borrow a stock, so if they think a stock's going to go down, they borrow it, they sell what they've borrowed immediately. With the theory of like, yeah, I borrowed these stocks. I know I have to return these stocks, not just the value at the time, but I have to return these stocks. So say I borrow 100 shares of Disney and I sell Disney immediately because I think Disney's going to down. At a certain time frame, I need to return those Disney shares. And the short seller, the way the short seller thinks is, I know it's going to go down. I borrowed it, I sold it, and now 2, 3, 4 weeks later, a month later, whatever it is, I know that Disney stock's going to be down. I'll buy it at this much lower price, and then I'll return what I borrowed, right? Well, so that's what a short seller is doing. But when it doesn't work, if that stock starts to move, whatever that underlying stock is, in this case, I said Disney. So say something fabulous happens for Disney. Say they have like their latest movie turns out to be the biggest hit. Nobody saw it coming. It's making a ton of money. And that starts to boost the stock. Well, that person who bet that the stock was going to go down, they're in trouble because they have to get their hands on some shares before the stock goes too high, right? Because they know they have to return the physical, the actual stock, not just the value of the stock at the time that they made the transaction. So then all of a sudden they go scrambling to get some Disney stock as it's going up. And then that makes the stock go up faster. So the famous example of this was the meme stock GameStop. When GameStop started to go through the roof and all of these investors were short GameStop, then that just perpetuated it because they had to get their hands on these shares. So, why did that stock price move? There are all sorts of reasons, right? Or even like starting soon this time of year, you'll see some stocks go down that really shouldn't, they've already gotten pummeled this year and then there's no new news, but they're deteriorating further. Well, that's tax loss harvesting. So people who own the stock, and this happens especially now in a good year where they haven't really been that many stocks that are down. So the ones that are down go down even further because people are trying to offset their gains with some loss. So that's what tax loss harvesting is. So all of a sudden now that stock's going down even further on no new news. So there are all different reasons why stocks move, but I just thought I'd throw this in here just so you didn't get the sense that behavioral finance is like the be all end all of everything. And really what's important is just to know behavioral finance for you to not get caught up in some bad behavior. But when you're watching what's happening with assets, yes, the behavior of other investors is important, but it's not the whole story. And one last thing I wanted to put in here, and sometimes investments just do irrational things. And even though no academics have really done papers on it or studied it, you'll have people in the investing world, and they talk about this all the time, like Cliff Asness, who runs AQR, who's kind of a celebrity in Greenwich because his business is in Greenwich. He talks about momentum all the time, that there's just this like phenomenon. It's irrational, like a stock that's gone up, sort of like in lockstep, just chugging along, going up, up, up. It has now surpassed the fundamentals, but it will just continue to go up. Nobody knows why. I mean, there are theories, sort of like this herd mentality theory. Same thing for a stock that's going down. If it's gone down and it's not tax loss harvesting time, but the stock has gone down, it will continue to go down. And this is called momentum, right? So a lot of top investors really get into momentum. But it's irrational. It defies the fundamentals. And you should just know about it also because if you're an investor and say you have a stock that's been performing really well, maybe hold on to it a little bit longer. If you have a stock that's really been performing poorly and you wanted to get rid of it anyway, get rid of it sooner rather than later because it's probably going to continue to go down. And nobody knows why, but here you go. Irrational effects in investing. Okay, so hopefully now you've got yourself under control and you know the things that might set you off. And again, this is being taped, so you can always look at it again at on the library's YouTube channel if you haven't been taking notes. Like you can kind of figure out where you're at risk behaviorally. But very often you have to do joint decision making, right? With a spouse or maybe an elderly parent if they're asking your advice about their retirement. Or if you have an adult child and you're trying to help them navigate like getting into saving and things like that. So when you're trying to navigate joint decision making, what are some of the extra things that you could be looking at from a psychological perspective? And again, we're going to get back to Morgan Housel, my favorite, The Psychology of Money. He has an entire chapter. The chapter is literally called No One is Crazy. And what he talks about in this chapter is that the research shows that people's lifetime investment decisions are heavily anchored to the experiences that they've had, especially experiences early on, right? So if, for example, if you look at the year like 2000 to 2010, like that was an entire, they call it the lost decade, right? It's terrible. But if you were a young adult in 2000 to 2010 in that lost decade, your impression of stocks might be they don't work, right? The entire, like, if you invested an entire decade, if you were good and you got into your 401k and you carefully selected, the different stock funds and you just waited and, say you were 25 years old in 2000 and then you're 35 years old in 2010, guess what? You didn't make any money. And that's a decade, right? Like that's so painful. So that person, if that happened to them, they might have a sense like, I don't care about stock market gains. I don't care what it's done recently. I had this, the formative impression is that stocks are not a good investment, right? So maybe that person doesn't even invest in their 401k. Maybe they only want to do real estate, right? Maybe they only invest in commodities. Maybe they only do bonds, or maybe they do everything but stocks, right? Because they have this tremendous formative, memorable experience, right? So they're not crazy. Their experience was very, very formative. And especially when it lasts a very long time, you can't argue with like a decade of no performance. Like that's pretty jarring. Meanwhile, someone else, gosh, I mean, stocks have just been on a tear for so long that anybody that's like 25 and like starting in 2017 or 2015 to now, they would be like, oh yeah, you have to be in stocks. Like that's the whole ball game. I mean, that's where you really make your money. So these are big differences, and it's not just the jarring stuff, right? Like obviously the financial crisis was a disaster, but if if something lasts for a really long period of time in your formative years, like that's very, very telling. So what does that mean? Well, if you're doing joint decision making, it's really important for you to put yourself in the shoes of the other person and what were their formative experiences. Or it might not even be how the market behaved. It might just be that, you say you were raised in comfort or, just there was just no stress about money, but somebody else was raised in like tremendous lack, right? Where, I don't want to say poverty, but maybe just like tremendous nervousness around money and there was never enough and maybe car payments weren't made or maybe nobody could afford college or thing, there were very like, fraught discussions about how could we ever afford these things. That person might have a very different risk tolerance than you. So this joint decision making is really about being empathetic and being curious, right? So I want to just mention, I want to jump ahead to this and then I'll go backwards. But probably the best TED Talk I've ever seen about how to navigate decision making is this Four Habits of All Successful Relationships with Dr. Andrea and Jonathan Taylor Cummings. And they just do such a good job. Like, when something's really, really important, like where are you going to put your money? They have these habits that they've identified, be curious, not critical. Like say someone's like, no, I don't even have a 401k because that's crazy. Like the stock market's a scam. I just, bought my condo and I'm trying to pay it off as soon as possible, and that's how I invest. Well, you want to be curious about why they have that opinion and not critical, right? Not like, are you crazy? Like, of course you should do your 401k just for the tax savings alone. Like, you could see like a lot of knee-jerk reaction of like, how could you be so dumb? But that's not very good in a joint decision-making process or in a relationship process. So they have these great habits, and I really encourage anyone to watch this TED Talk, which you can easily watch on YouTube. But in these decision making, like how whatever the other person's opinion is, be curious, not critical. Be careful, not crushing. Ask them questions. Don't assume that they're on board in the way you're on board. Even if it's joint decision making of like how much money should be saved, versus how much money should be spent during the year. And then always like make sure you're connecting with that person before you're correcting them, like you're having the good times and not just always bogged down in sort of the grim decision making and all the serious stuff. So that's something I really, really recommend. And then me personally, from reading so many books and talking to so many people, I am fascinated about how there seem to be these two camps, really, where there's like, what is the goal here? Like, why do we even want to have enough money or a lot of money or more money? And there's this camp that's like really into power. And by power, I mean like, well, they definitely don't want to be restrained, like have any concerns about like we can't afford it. But also like they know that if they are successful, they'll have access to interesting people. Maybe they could even have like influence, I'm called before like a Senate panel, or, like politicians want their opinion, or maybe they can even become a politician like Mike Bloomberg did, become mayor. So it's so interesting to me, the people who want money because they really want power. They want influence, they want access, they want a bigger life. And then there are other people who, for them, money is just all about freedom, right? So you don't have these constraints. Like, say you have a terrible boss, you can quit your job. You just don't have to worry. You're like, I don't have to be controlled. I don't have to be constrained. You know, it's so interesting to me, these people who have a vision of like the most important thing is control over my time, being able to spend time with my family, being able to do the things that interest me. And these two camps seem to be really different, right? And I have no judgment, right? Like if you want to hang out with like really cool people and maybe influence like the direction of, I don't know, the town of Greenwich or New York City, or even end up being a senator. I don't know. God bless, like no judgment here, but you should definitely know when you're in, especially if you're in a very serious relationship with a spouse, or you're thinking of getting married, or this is your spouse, you gotta know what they're thinking, because maybe you're thinking freedom and they're thinking power and influence, and you guys are just never going to make sense to each other. So that's, for what it's worth, that's my armchair psychology right there. And again, I just love this couple. They're sort of famous for doing this, of like helping people navigate a successful relationship. And these habits would be so helpful to anybody that is trying to do financial decision making with another person. Okay, quickly on motivation, and then we'll get into any questions. If you have a question, you can just go ahead and put it in the chat. I actually, oh, I've been so bad, I haven't even looked. Okay, there's been one thing in the chat for a while, so I thought that might be, uh, what is that? Oh, I can't really see what that is.
I don't think there's any questions in the chat right now.
Oh, okay. Yeah, I don't know what that is. Okay. Okay, the last thing just on motivation. All right, so I think it's important, like what are the big practitioners out there saying about motivation, not just your decision making, but your motivation. And it's interesting to me, they kind of fall into three camps. And it's not just, Rami Sadie is the only one saying this, or Farnoosh Torabi is the only, Torabi, Farnoosh Torabi. So these are people that are like, very well liked within the personal finance sphere. Certainly, Dave Ramsey is very well known. These aren't the only people saying it, but I'm just sort of showing you the three sort of big motivators that whatever it's financial advisors or personal finance gurus or whatever. This is what they're talking about. So Ramit is really into like visualizing pleasure. I kind of think of it as like visualize the feelings that you might end up having, like, the feeling of like power or control or, no worry or whatever. But he's really into the positive side of the equation to motivate yourself. Farnoosh is the other side where it's almost like, in A Christmas Carol where you're visited by like the ghosts of the future. Like, what if you never change your behavior? Like, you're gonna have this ghost, like you're in a lot of trouble. So she wants you to visualize like the pain of like, if, say it's 10 years from now, you didn't change your behavior, you didn't start saving, right? Like, how horrible are you going to feel? So she's very much in the pain camp. And then Dave Ramsey and other they're just into like the quick wins, right? So in order to motivate yourself, I mean, Dave Ramsey, especially when he talks about paying down debt, he's like, don't look at the interest that you're paying. Even if you have a credit card charging 24% interest and you have a car payment that's 8%, if you only have like $1,000 left on your car payment, but you have $10,000 on a credit card, ignore the credit card. He actually says this, and people who are really into math and logic hate it, but he's like, you want that quick win of getting rid of that entire debt of the smaller debt first. So in his plan, his total money makeover, he's like, list all of your debts from the smallest amount in an account that you owe to the largest amount and pay off the smaller amount in its entirety first before you pay anything else other than the minimum fees. It's really fascinating, but he's in this sort of quick win motivation camp, and he's had amazing results. Okay, so questions? Anybody? How you doing? How you feeling? Are you feeling motivated? Are you feeling like you got this? Um, I hope you had fun. I certainly enjoyed talking to you about cognitive bias for an hour. Um, let's see. Anything in the chat? Okay, I think we got one. Let's see. What do we have? What do you think about Michael Burry in Big Short? I love Michael. I love The Big Short, but I'm not sure what you mean. So Michael Burry in The Big Short, he was the one who wanted to short like the entire housing market because thought it was all going to come crashing down. So, okay, Justin, I'm not sure what you meant by that. Like, what did I think of him? Obviously a genius. I don't know that he was really driven by any particular bias. He seemed to really know. He was actually he himself said that he thought he was on the spectrum, so he might be a little bit more immune than others to bias. He was a little bit more of a robot, like really able to like read the prospectus on all different kinds of debt and do very logical, almost robotic things. Okay, so sorry, I don't understand that question, but definitely a fan. Okay, what's the next question? Thank you for the informative, clear presentation. I certainly enjoyed listening. Since I've read Daniel Kahneman's Thinking Fast and Slow, my question is, if more and more people learn behavioral economics and avoid biases or heuristics, won't people get smarter, especially the professional investors? And in the end, there will come a time when the behavioral economics biases won't be valid. Yeah. But what really moves, like prices, asset prices kind of move at this margin, right? So it's weird. It's not really based on the majority as much as like what's happening at that margin. And I feel like, I mean, maybe it was the boys who painted my porch. I feel like there always going to be really there's always going to be stupid behavior out there. So I see your point. I guess it could happen. I'm not too worried. I think there's always going to be some players in there that are not behaving correctly. And it doesn't have to be that many to get the price movement, would be my opinion. But I'm glad you're reading Thinking Fast and Slow. Great book. Really gets into how we have these two, sort of ways that our brain works, where some things are much more like thinking fast, like knee jerk. We're not going to slow down. We're sort of conserving energy and using mental shortcuts and sort of doing things like more knee jerk. And then there's the thinking slow part, sort of the system two part, where we are more deliberative, or taking in new information. So Danny Kahneman, who's he won the Nobel Prize. It was one of his best-selling books, Thinking Fast and Slow, and definitely worth a read if any of tonight was of interest to you. Okay, any more questions? Oh, thank you and thank you. Yes, you are very welcome, and I've had a great time talking to all of you. Yeah.
All right, that looks like it's all the questions. And I did post in the chat the link for next month's session, which will be on alternative investments. So click on that link and sign up if you're interested in joining us. And thank you very much, Kristen.
Thank you. Have a great night, everybody.
Thank you, Kristen.
Good night.
Good night.